Hello, my name is Chris, and in this video I'm going to answer two very commonly asked viewer questions. And these questions are as follows. Do I need to convert currency from my home currency to the trading currency of the products that I'm trading? And the second question would be, if I choose to convert my currency from my home currency to the trading currency, how would I go about hedging the currency risk associated with converting to a different currency? Because one day I do want to convert back to my home currency, and of course, over time, exchange rates will change and you might be subject to making a profit or a loss when you convert your currency back to your home currency. So how would you protect yourself against that risk? If you guys enjoy my content, let me know with a comment down below on the video. I really appreciate it when you guys give me video suggestions. Over here at VerrilloTrading, I cover a wide variety of trading related issues and trading service related issues. And specifically, I'm a specialist in the interactive brokers trading service as well as Sierra Chart as a trading software. So if you guys have any special requests or questions related to those things, you can feel free to send me an email, support@verillotrading.com. And if you guys want to support this content, you can click on the first link down below and check out Interactive Brokers. I appreciate it very much. So let's get it right to the question. So the question is, do I need to convert my home currency to the trading currency? I'll give you a simple practical example. It's very common. Investors from Canada or from the United Kingdom or from Europe, they might open an Interactive Brokers margin account and they might want to trade US stocks, US options, or some other markets that are not denominated in their home currency. The short answer to the question is, it is not obligatory to convert from your home currency into the trading currency in order to trade these products, if you have a margin account. That's the catch. Because with a margin account, whatever assets you deposit into your account, they could also be positions that you transfer from another account. So you could transfer positions into your account, or you could deposit cash into your account. It doesn't matter what the currency of that cash is. It acts as the necessary collateral for you to enter into any type of positions that are supported on Interactive Brokers. So you can deposit Canadian dollars into your account or British pounds, and then you can go about and trade US stocks, US options, or European stocks, whatever you want. Basically, you can trade anything you want, as long as you have the necessary collateral in the account to take care of the capital requirement for that trade. So it is not obligatory to convert your currency. Now, there is a catch to it, of course. If you guys go and watch my video about margin trading, you would know this. And there's actually a number of videos that I think you guys should watch. Definitely check out the Interactive Brokers playlist I have, because there's a lot of videos in that playlist that go over some popular topics as well as some more remote topics that are more advanced investment strategies. And I do want to say, by the way, that nothing in this video is any recommendation to place any particular trade. And I will be talking about ideas that relate to trading currency swaps, currency spreads, and margin trading, all of which, in my opinion, is considered more advanced, and it should be done by experienced investors only that fully understand the risks that they are taking. So if you watched my margin video, you would know that when you enter into a US long stock position, it uses your cash balance in the currency that the stock is denominated in. So if you go into the US stock market and you buy 10,000 US dollars worth of Apple stock, your US dollar cash balance will go down by 10,000 US dollars. So if you funded your account with a currency other than US dollars, let's say pounds or Canadian dollars, and your US dollar balance is zero, then you bought the stock for 10,000, your resulting cash balance is going to be negative 10,000 US dollars. Now that's perfectly fine. You can actually maintain that negative balance for as long as you want, and there will not be a problem. But there is a catch. The only catch is that you need to pay interest on overnight negative cash balances. And of course, the reverse of that is Interactive Brokers specifically does also pay out interest on positive cash balances. There are some terms related to that, and you can check out the video I did about that there. I will show you it here as well. When you have a negative cash balance, you do need to pay interest on that negative balance. The thing is that some investors, decide to hold positions for a long period of time. You might be a swing trader or an investor, and you plan to hold that stock or that derivative or whatever position it is for multiple days, multiple weeks, multiple months, maybe even multiple years. Obviously, you don't want to be paying overnight interest, or you want to reduce the amount of costs you have to pay that relate to overnight interest. So how would you go about solving this problem? Well, one way of solving it is to convert your home currency into the currency of the products you're trading in. So if you're trading US stocks, you would convert your home currency into US dollars in order to cover your negative balance. So like I said with the previous example, you bought 10,000 worth of stock. You don't want to have an overnight negative balance, so you convert your Canadian dollars or British pounds into US dollars in order to cover the negative balance and bring your US dollar balance back to zero, or positive if you prefer. And of course, this presents another problem, which is called currency risk. Some investors may not want to go long in the currency of the products they're trading. They just want to be long the products they're trading, not the currency that's used to buy or sell those products. So someone who's from the UK, for example, I'm going to give this example. They're long the British pound and they want to stay long the British pound. They do not want to convert to euros, they do not want to convert to dollars, and they certainly do not want to convert to Canadian dollars. Just joking. So how would they go about hedging the risk? And that's what I want to present to you, the concept of hedging. Right now, I'm going to give you two examples of how to hedge currency risk when you convert your home currency to another currency that you might use for trading. In this example, the home currency will be GBP, or Great British Pounds. And the trader or investor is converting their currency to euros because they're trading European stocks or European denominated warrants. That is a product that's available on Interactive Brokers, by the way. So now we'll follow this text document here. You guys will get an idea for how to fix this problem. Okay, so option one is to use a separate trading account to simultaneously go long or short the currency in order to hedge against the negative cash balance in account one. And it's not a negative cash balance. Actually, what it is you converted your pounds to euros and you now need to regain that pound position and go short the euro in account number two. And the way you're going to do this is by doing a leveraged forex trade. So you need to make sure that whatever broker you're using for account two allows you to do what's called leveraged forex trading. Interactive Brokers has this. I think they allow up to about a 40 times leverage. Don't quote me on that. You have to test it yourself because their margins and their capital requirements sometimes is subject to change. But from what I've seen, it sometimes goes up to about 40 times leverage. So just to recap, in account number one, the trader sold 1 million British pounds for euros because they're trading a lot of euro stocks. So they need to make sure that they don't have any euro negative balances because they're investing in European denominated markets. So what they do is they sell their 1 million pounds. Now it results in a positive euro cash balance, just as a hypothetical example of 1,191,000 euro. And their British pound position is zero. But the problem is, of course, the investor does not want to be long the euro cash. They still want to be long their 1 million pounds. So in account number two, this is what they need to do. They need to do something called a leveraged forex trade, and they need to go and basically short the EUR.GBP currency pair. These are the positions in account number two minus the collateral needed to enter the trade, because I don't know the exact capital requirement that they would need. Note is that the investor needs to fund account two with enough collateral in order to sell the right amount of EUR.GBP as a leveraged forex trade. So they go ahead and they sell 1,191,000 euro in order to buy about 1 million pounds. So the investor is selling the amount in euros that they have in account number one. They're selling that same amount in account number two to regain the 1 million pounds that they had in account one. And what happens with this is the result. In general, they will earn interest on any positive cash balances in the account. Of course, it's subject to the regulations that they have for positive cash balances. And you can watch the video or you can view their page talking about interest rates. And I believe that that page is, the way you get info about that is you go to their website, interactivebrokers.com, then you go to pricing and select interest rates, and it'll give you all the info about how much interest they pay and the terms and conditions that they have for paying interest on positive cash balances. So what happens here is that in account number one, the investor will receive a positive rate of return on their positive euro balance, but their euro balance is probably invested in stocks or warrants or other euro-denominated assets, so they may not be earning interest on that position. In account number 2, the investor will be earning interest on the positive pound position, and they will be paying an interest on the negative euro position. So one thing to pay attention to here is obviously how much interest is being earned and paid on this currency spread right here. So just as a quick example, if I go to their page here, interest rates, and I look for British pounds and euros, you can see that GBP, they pay out 4.692% on positive GBP balances that are above the threshold that they specify. And for euros, actually, to see how much you have to pay in interest, it's a different page. You have to go to pricing and then margin rates, and I have it right here up here. And you can use this calculator, or you can just look at the rates that you have to pay down below. And for the euro, they charge an interest rate of 5.178%, and if it's above this threshold of 90,000, the rest of it gets a lower rate. You get charged a lower rate of 4.678%. So it's up to you to calculate the difference of how much interest you're paying versus how much interest you're earning on those positive and negative currency balances. And what I'm talking about here is specific to the Interactive Brokers trading service, because I know for a fact that they do charge you interest on negative cash and they do pay you interest on positive cash. But with other brokers, it might be different. And then the overall result is that the investor should net somewhere close to flat on the overall currency spread. I don't think it'll be a 100% perfect hedge because interest rates do vary and the investor may not be able to achieve a perfect hedge, but it will be close because in account number 2, you're long the pound, short the euro, and in account number 1, you're long the euro cash. But again, one problem with this, I would say, is that in account number 1, you're still not really long euro cash. You're long assets that are denominated in euro cash, which obviously the value of those assets does not follow the value of the currency being used to pay for those assets. They have their own value. But you are still hedging the currency risk that when you close those euro-denominated positions, you get the euros, and then at some point you want to convert back to your home currency. So you are hedging the currency risk. Let's go over to option number 2, which in my opinion, I think it's a little bit more efficient, which is to use the CME Group currency futures to hedge the exchange rate between your home currency and the currency you're trading. So the CME is pretty much the biggest futures exchange in the world. The advantage of using this method is that it's possible to do it all in one account at Interactive Brokers. And the CME exchange trades currency futures, which are supposed to maintain a very precise correlation to the spot exchange rates. So some examples of these futures contracts would be 6E. These are the ticker symbols. So for Euro USD futures, 6E. For British Pound futures, 6B. For Swiss franc futures, 6S. And for Canadian dollar against the US dollar, it's 6C. And there are also some more remote currency pairs like EUR.GPB futures under the symbol RP. For the example that we're using here, where the investor from the UK converts their pounds to euros and they want to make up for that euro exposure and go long the pound, they can do it using this RP futures contract here. So the first thing to do when using futures to hedge is you have to look up the contract specifications for the futures contract. You could either do a Google search for CME EUR.GBP futures, and you would basically get brought to this page right here. So this is the futures contract for euro against the British pound. And then you would select specifications. It will tell you that the notional size for each of these futures contracts is 125,000 euro. So the total value of the futures contract is 125,000 euro. Now you don't need 125,000 euro to enter this position because futures are leveraged products. If you go over to margins, it'll tell you what the capital requirement is, and the overnight margin for this futures contract is 1700 GBP. So that's how much you need to initiate a position in this futures contract and also maintain it overnight. Typically, the investor is not going to hold the futures contract until the settlement date. What they're going to do is roll the position to the next expiry in order to maintain their hedge, okay? And if I'm getting a little bit specific on you guys, don't worry, I'm gonna show you more examples and kind of make it easy to understand for beginners. I just wanna make it clear that this is a derivative contract that tracks the value to a near 100% correlation to the EUR.GBP currency pair. And for example, in Interactive Brokers, you would go into your watch list and you would type in RP, and this would be the symbol. So you can see that's what the chart for this looks like. And if I select EUR.GBP, the currency pair, you'll see that it looks like the same chart because it has a strong correlation. It's the same exact market that we're looking at. So back to our text document, this is what we would do. The first thing is, of course, the investor converts their British pounds to euros because they're trading in euros. But then, in order to make up for that long euro position, they want to gain back the pound exposure against the euro. They would go in and sell short the RP futures for the same notional amount in pounds that they want to regain exposure for. So if the investor's original cash balance was 1 million British pounds, you have to then use the notional contract size of the futures contract, which, like I just showed you, it's 125,000 euro. What they want to do is they want to sell short that futures contract for the amount in euro cash that they have, that they've converted their pounds for already. So if you've been following, the long euro cash position that I stated earlier was 1,191,000 euros. So what they need to do is they need to take that amount and divide it by the notional contract size of the futures. So in this case, 1,191,000 divided by 125,000 is going to tell us how many contracts, futures contracts, we need to sell short in order to regain the pound exposure of our 1 million pounds approximately. And what you'll see here is that it equals to 9.5 contracts. And I'll explain this problem here in a second. Obviously, we would prefer it to equal to 9 contracts or an even number of contracts, right? Because you can't go in and sell 9.5 contracts. You can only sell fixed number of contracts. So the investor would go in and sell 9 or 10 contracts of EUR.GBP futures, which is going to give them a long position in the pound against the euro. This is the hedge against their long euro cash position, which they plan to convert back to pounds at some point. Note, there's 2 notes here. The first one is the investor is required to roll the futures position before expiry, or they will need to provide delivery or accept delivery of that particular currency. So what a roll typically is before the expiry date of the contract, typically about 2 to 4 weeks before the expiry of the contract, you sell your futures position and you buy the next futures position. So since we're shorting the futures contract, what you do is you would buy back your short on the current active month contract, and then you would go and short the next month contract. So just as a quick example of what the roll would look like, so I want you to hypothetically imagine that I am short 10 of these RP contracts. Let's say I'm short 10 of them. I just put in a sell order there. I'm not going to do it because this is a live account, right? But let's say my position is short 10 of these September expiring euro against the pound futures. As we get closer and closer to that expiry date, unless you want to provide delivery of that futures contract because you are short the futures contract, you're going to have to roll your short futures position to the next expiry. And the way you're going to do that is like this. So you go into your watch list, you type in RP, which is the same futures contract, you select it, and then you select the next month's expiry. So the current active month is September, so we don't want to select September, we want to select October. So we click October. Now we have October here in our watch list. Now the price will not be exactly the same because futures across the calendar sometimes trade at a premium or at a discount, but that doesn't matter. What's important for us is that we're maintaining our hedge against the currency risk because we do not want to be exposed to the profit or loss when the exchange rate shifts around. And that's what this futures position is protecting us against. So when it comes time to roll the position, what we're going to have to do is we're going to have to buy back our short 10 contracts on the September contract. So I put in a buy order, 10 contracts. We're going to buy it back. And at the same time, we're going to go into the next month contract, October, and we're going to sell. So right click sell, and we're going to sell the 10 contracts there. And that's basically how you roll a futures position. Obviously, I didn't transmit the orders, but I'm just showing you how you would do it yourself in your account. Now back to our text document. Now, of course, the example I gave resulted in a hedge of 9.5 contracts. Ideally, what you would want is when you're converting your home currency to the trading currency, you want to convert a notional amount that would line up with an even number of futures contracts based on the notional size of the futures contract, which is 125,000 euro. So basically, instead of converting the currency first and then hedging it later, what you have to do, or what I would prefer to do, is plan for the hedge before you convert the currency. That way you could achieve a more precise hedge. So let's say approximately you wanted to buy 1.2 million euros. What you should do before buying those euros for pounds is you should take the notional size of the futures contract and multiply that by a number of contracts that you might need to use to hedge. So let me just show you that. So you would do 125,000 times, say, 10 contracts, and that gives you 1.25 million euros. So that's how many euros that you would need to buy for pounds in order to then go in and sell 10 EUR.GBP futures contracts in order to achieve close to a 100% precise hedge. So that's the note here that I wrote. It would also be smart before selling the home currency for the trading currency to plan to buy an amount in the trading currency that you will be able to hedge with near 100% precision. In the example above, our 1 million pounds yields us an amount in euros that is equivalent to 9.5 EUR.GBP futures contracts, which of course is not a precise hedge. It's close to precise, but it's not hedging the entire currency risk. We would prefer to have an amount that is equal to or closer to a round number of futures contracts. Okay. Thank you very much for watching this video. I hope you guys learned a little bit about hedging currencies, and I will see you in the next video. Thank you very much. Take care.